Good afternoon, and welcome to the 2023 Macro and Credit Outlook. I am Dan Kern, the Managing Director and Chief Investment Officer of TFC Financial Management, and I'm excited to be here with you today to introduce Joe Kalish, who will talk to you about all things macro credit, and he may explore some things other than macro and credit. Joe is the Chief Macro Strategist for Ned Davis Research. Joe has been following and studying financial and economic trends for almost 40 years. He and his team are responsible for all of NDR's bond and economic analysis. Joe does a lot. He authors several publications writing on global and US fixed income strategy and trends twice a week. So he's a prolific publisher. He is also a regular contributor to other macro publications, including featured reports, the US Economic Focus, and the US Daily Economic Perspectives. On top of all of that, his team also assists NDR's equity strategists by identifying relevant economic trends and fundamental themes while providing historical market perspectives. In addition to Joe's bond and economic analysis, he's held a number of other positions since joining the company in July of 1986. So I will repeat, July of 1986. Joe's somebody who's been through a lot of different markets and a lot of different economic environments. He's a member of the National Association for Business Economics and is a regularly quoted and interviewed speaker by the financial media in the US and internationally. He received his Bachelor of Science degree in Information Systems Management, cum laude, from the University of Maryland, and his Master of Business Administration degree in Finance with distinction from NYU's Stern School of Business. I think we are very lucky, very fortunate to have Joe here speaking to us today. He has 45 minutes to an hour of prepared remarks. We will be taking Q&A as we go. I will cover Q&A with Joe at the conclusion of his prepared remarks. Please include your questions in the chat box. Please don't be shy. If you don't have questions, I know I do. So without further ado, here, take it away, Joe.
Thanks, Dan. Well, let me get started here and share my screen. Can you see that? Okay, I'll take that as a yes.
Yes, you're good to go.
Great. All right. So let's get started here. We've already gone over the title, Macro and Credit Outlook. Here's what I'm going to be covering. We'll talk about inflation first, and then we'll talk about the economy, talk about the Fed and monetary policy. Then we'll get into some market specifics. We'll talk about fixed income space first, then we'll talk a little bit about equities, and then the dollar and some alternative investments as well. So going to be a wide-ranging, multi-asset discussion, but we're going to spend the first half of it just talking about the macro outlook and macro backdrop. So, Jimmy, why don't we get started here with our first poll question? The first poll question is, where will the CPI end up in 2023? Right. Most people are thinking inflation is going to be relatively high, 3 to 4% at the end of 2023. With half of the respondents giving that. Less than 20% think it's going to be less than 3%, and nobody thinks it's going to be under 2%. And there's about a third that think it's going to be above 4%. Well, then I've got, I think, some interesting perspectives and remarks, and may have you, think through some of those responses. And let's turn to the inflation outlook. I'm going to look at inflation from 3 different perspectives. First is the short-term perspective. Then I'm going to talk about the intermediate perspective. So short term, less than a year, intermediate term, 1 to 5 years, and then sort of this longer term view. And we're actually seeing quite a bit of progress on the inflation front. This morning's report, which probably most of you saw, sort of in line on the core, but definitely heading down. And there are a number of indicators that we're following, particularly on the supply chain side, that have really shown a lot of improvement. So this is the New York Fed's Global Supply Chain Pressures Index, and we actually have it advanced by about 6 months here. So these improvements in supply chains are going to be with us through the first half of this year, and you can see that follows pretty closely, and inflation should follow that pretty closely over the next few months. We're also seeing other types of indexes, right? Supplier deliveries indexes that you see from ISM, or the input price indexes, are all retreating now. So there's a lot of improvement on this supply chain front. Now let's take a look at the PCE price index and break it out a little bit differently. So everybody knows about headline and core. What I'm doing here is breaking this PCE inflation out into durables, non-durables, and services. So durables, this is in November. We had already declined from a peak of about 10.6% to 2.7%. I think we're heading lower. I think we're going back into negative territory. And if you look at this chart, you'll see prior to the pandemic, we had been in deflation in the goods sector for about 25 years. So since about the mid-1990s, goods prices, durable goods prices, had been deflating on average about -2% per year. So getting back down to -2% should not be that unusual or surprising. Let's take a look at the non-durables. So durables, everybody knows, right? These are things like vehicles and furniture, appliances, things that are going to be have a lifespan of 3 years or more. Non-durables, that's typically thought of as food and energy, apparel, things like that. That's starting to come down as well. So this was now from about 13% or so to 8%. That's heading lower. Now, if you look at commodity prices, now commodity prices are not, a perfect substitute for non-durables. But commodity prices are down 15 to 20% from their peaks last year in March and June. You sort of have like a double peak in the index that you look at. But we're down 15 to 20% from those levels. And you can see after you've had pretty good surges, you have some pretty good declines. And again, not unprecedented to end up in negative territory. Can we end up at -2 later this year? I think that's entirely possible. Then you get to services, right? So services is going to be your shelter, it's going to be your healthcare, and then everything else, which has a large wage component and compensation component to it. So shelter is going to be heading down. We know that from sort of these private rent surveys. It didn't show up yet, or hasn't shown up yet in the CPI that we got this morning. There's still pretty strong growth in shelter costs. It takes some time for that to happen, right? And there are lag effects. And I think by the time we get into Q2, we're going to start to see some slower growth in shelter, and this will start to roll down even more. We're already down from this peak of 5.5% that we had in October to 5.2%, about 5.25% in November. And can we get this to come down as shelter comes down? Can that end up going down to about 4%, later this year? Again, this is still going to be sticky because of the wage component and compensation component, but can we get that to 4%? I don't think it's unreasonable that we can get that kind of movement. So hang with me here. So what matters is the waste, right? So durable goods, right? That's only about an eighth. Non-durables, that's about 20%. So those two are about a third, and then services about 2/3. So if you've got about a third at -2 and 2/3 at 4, you end up at 2. There's a path to get to 2% on PCE inflation. Now, whether we'll stay there is a different story. And there's timing and aspects and sequencing aspects of this. But I think there is a path to get there. Let's take a look at, this was what we were showing here. House prices have gone up. They tend to lead rents by about a year and a half. I think that time is a little bit shorter now because the Fed was so aggressive. But as I'll show later, as we get into the intermediate outlook here, there's really 3 areas that concern me. And they're all supply constraint related, right? 1 is shelter, 2 is commodities, and 3 is labor. So again, we're going to see prices for rent coming off, but as everybody knows, mortgage rates got up to 7%. They backed off some since then, but that's killing demand. It's also killing supply, right? So if you're a builder, you've got to go out there and take out a construction development loan. Well, those loans are harder to get. They're more expensive, so you're less likely to provide that supply. And once demand comes back, whatever sluggish period of growth or recession that we go through, we'll talk about that in a few minutes. Once that demand comes back on the other side, prices are just going to come back, right? Because there's this demand out there as larger demographics. Again, I'll talk a little bit more. Here's the rent index, and this is the Zillow rent index peaking out. We don't really see it showing up yet, right, in the CPI. But again, there's a lag effect by the time these things roll over and you start to see those. The second area that I'm concerned about in terms of being supply constrained with the commodity space. And so particularly, I think the story is now well known about energy, the lack of investment. Because the lack of investment coupled with climate change can really lead to what I've called the age of scarcity. Right? It doesn't mean everything is going to be scarce all at the same time. And there are seasonal effects. It's just this variation around a trend. And we did see this last year, right? And so this lack of investment story was before the Russia-Ukraine war. And we got up into record highs for many of these items. Some of them are reversed. Nat gas in particular has come down hard over the last couple of weeks here. Coal is off its peak because we don't have as much demand for winter heating. But also take a look at this, these lines that I've drawn in here. So we had that huge surge, of course, in 08, right? And then after the GFC, prices came down. They came down hard. And then China went on this spending boom. We had this China-driven global demand theme that kind of peaked in around 2011. And then we kind of went sideways for a bit. And then when oil prices kind of broke in 2014, 2015, we ended up in this downtrend. And this downtrend lasted until, into the pandemic. And you have to remember, all the central banks around the world were failing to hit their inflation targets, which all, they coincidentally are around 2%. Some are up 2 to 3%, but basically call it 2%. Well, if you have declining energy prices, it's going to be really hard to hit your 2% target. And we were in there for years, right? But there's also the other side, right? There are years where prices go the other way. And this lack of investment is probably going to contribute to that upward pressure on prices. Another area is food. This is the FAO Food Agricultural Price Index, the monthly chart here, the other one is weekly. You can see over that 10-year period post-GFC, you get the China-driven commodity demand boom into 2011. It peaks out and was on a downward trend for 10 years. So you have both food and energy prices declining for 5 to 10 years, and central banks complaining we can't hit our inflation target. Well, you've got a 20 to 30% headwind because food and energy prices were going down. So it's going to be really difficult to hit that target. Now we're on the other side of it. So we may see a lot of progress getting down to 2% in the short term, but will we be able to sustain those levels of decline and get down to that and stay down at 2%? I'm somewhat skeptical. Again, there's linkages here. I'm not going to go through all of it, but we've had wet weather problems create, and that weather could be either heat or drought. And we've seen this all over the world. We've seen it in Europe and North America, and Latin America, Australia. And so all kinds of places are facing extreme weather events, and this is wreaking havoc with agriculture. And so you're going to get spikes coming through. And again, the lack of investment, the lack of awareness, and it's just kind of fueling all this. Nobody really wants to invest in that whole fossil fuel type of energy because we're moving to green. So why invest? It's just going to just lack of demand. And so and all that leads to climate change, and it just goes round and round. So that's the second area. And then the third area is the labor market. And this is a chart that doesn't get enough play in my mind. And this is something called the Beveridge curve. And it's a relationship between the unemployment rate on the x-axis here and the job openings rate on the y-axis. Now you'll hear about a lot of people talk about the job openings, the number of unemployed, which is sort of what this gives you an idea about. But you'll see that there's actually a pretty decent curve that's traced out in each of these last few cycles. So 2000, 2009, so that post-tech bubble through the GFC and sort of that recession there, to June 2009, those are the blue squares here. Then we went into the post-GFC experience up until the pandemic. Those are those orange dots. Again, pretty decent curve. And then we're in the post-pandemic world here, from the pandemic on, these triangles, again, generally fitting on a pretty good curve. So with each economic cycle, we have been moving further and further away from the origin. So we continue to have a higher level of job openings for any given level of the unemployment rate. And this, to me, speaks of mismatches. So we have all kinds of mismatches, right? We have a skills mismatch, right? So we've got maybe tech jobs that people want to have filled, and we don't have enough people to do them. There could be geographic mismatch, right? There may be jobs available here in Florida where I am, and there might be people who are unemployed in California now. Are they likely to pick up and move? But pretty high hurdle, especially if it's a low wage type of position. That's not likely to happen, and the mobility has actually declined, over the years in the U.S. So then there's a demographic impact, right? So there might be certain types of jobs that are available, but you need certain types of workers for them. For example, you think about all the housing construction that's gone on in some of these areas, and it's generally those are younger workers. You're not going to find all the work. So it's not that there's discrimination. It's just like, you know, you don't find that many 60-year-old roofers. You just don't. And so there's a you know, a demographic mismatch. And then there's you know, there's also this pandemic. You know, people haven't come back or they've gotten sick or whatever. You know, we've restricted immigration, which used to be an outlet. So there are a lot of reasons, structural reasons, why you know, we have sort of this outward movement and these mismatches in and that's represented by the beverage curve. Now I have here the Fed's magic carpet ride because they think magically job openings are going to come down and the unemployment rate's only going to go about 4.5 or 4.6%. You know, that's what I call the Fed's magic carpet ride. In other words, they're basically arguing that we're not going to go back on this curve, which again, there's no historical evidence for that. Maybe it can happen, but there's no historical evidence that we've ever been able to achieve the magic carpet ride. All right, let's take a look at, again, labor from a different perspective, from the cost perspective. And you'll hear people talking about, oh, well, wages are too high. And, you know, you hear Powell say, well, we want to see wage growth about 3.5%. You know, it's too high right now. 4.7 to 6%. Then a Fed wage tracker came out. It's coming down, but it's higher than average hourly earnings. And well, of course, I mean, of course they're higher than what you want it to be. I mean, look what happened last year. People got, you know, hit with a sledgehammer. That inflation went up, you know, 8-9%, and they're going like, even 4 or 5%. I'm not keeping up with inflation. Real wages were going down. So there's a lag effect, right? But why don't we just all calm down? Right? There's a lot of noise. I mean, you hear people talk about wage price spirals and like, oh, you know, going back in the 1970s, it was wage price spiral. And I'm looking at this. This is what I like to pay attention to. It's called real labor costs. It's real non-farm compensation, right? So that's generally been negative. Less productivity growth, which has also been pretty horrendous. And when you take those out, I don't see a lot of, you know, wage pressure here. Really are declining. Now, if they're up in this section in here, then I've got a problem. I've got these little boxes here at the bottom that says, you know, when you have a sustained rise in real unit labor costs, then labor in and of itself is driving inflation. That's not happening today. It's just basically captured. So that's a really important point as to, you know, whether compensation is really going to be problematic. Right now, I don't find it problematic. Again, as the labor market remains tight, as long as, and the longer these conditions remain in place, then the more confidence people will have. Again, I'm not worried about it in the short term, but as I look out over the intermediate term, it is definitely more of a concern. Now let's take a look at the long term. The long term, I'm still mostly coming down in the disinflation camp, right? I've got still a high degree of technology and innovation going on. Globalization and competition is still pretty high. Now, I don't use the term deglobalization. I use reglobalization. We're seeing a slowing and a reconfiguration of supply chains, right? So we're going to be doing more trade with Europe. We're going to do more trade with Mexico, maybe more trade with Latin America, other areas, right? Other economies than China and Russia. Right? So we're still going to be doing trading. We're just going to be doing it with different trading partners. Right? So we're this term deglobalization, I think, has almost become, you know, like just commonplace. And I think once we, you know, settle things out, I mean, there is some reshoring coming on. Yeah, I get that, but you know, there's going to be different new trade patterns. So it's just going to look a little bit different. Aging demographics, high debt levels that has to be serviced, and well-anchored inflation expectations. So most of this is still intact. On the inflation side, I'm still finding a lot of these things lacking. Monetary policy is no longer accommodative. Fiscal policy bouncing around between super accommodative to not accommodative, back to somewhat accommodative. Again, demographics are moving up a little bit in the short term because of millennials, but generally when you look around the world, there's aging demographics. And credit growth is also needed. So, and unanchored inflation expectations. If you think back to the 1970s, we had all these, right? Monetary policy was generally accommodative or, got abandoned too quickly. Fiscal policy was generally expansive. Young demographics, right? Low levels of credit that allowed for the addition of credit to balance sheets, and inflation expectations became unhinged. This is a setup that we'll probably never see again. Certainly in my lifetime, but maybe in your lifetimes as well. And so, this 1970s, 80s period was really an anomaly of a lot of these factors coming together all at once in a problem. So it's really hard to see how inflation is really going to get out of hand beyond these supply side constraints that I mentioned. So when I'm looking at sort of a 10-year period, I really just can't see inflation really getting back. So, Jamie, I think we're up to the next poll here. We're going to talk about the economy. And question here is, when will the economy enter into recession? Choice number one is we're already there. We're already in recession. Number two, somewhere in the first half of this year. The third option is the second half of this year. And the last option is next year or later. Think about it. So soft landing, no landing. Let's please select one of those and give you a few minutes, a few seconds here to gather your thoughts and already about a 30% or 31%. I think we're already in one. That's pretty interesting. But not evenly split, but fair representation first half, good representation second half. And so most people think we're going to be, we are in a recession, we're going to be in one this year. Very few people actually think we can kind of avoid. So let's take a look at some charts and some analysis and see what. So I want to share with you, this is our one of the models that we use. It's our economic timing model. And it is saying that we are essentially in or can be in a recession if anything. We're in a sort of this mild recession category, -8, and this model tends to be to coincidence. Now, what's in this model? There's a lot of indicators in it, but it has a heavy dose of financial conditions indicators. So it's got stock prices in there, and bond yields, and credit spreads, and lead indicators. So it has a healthy dose of this financial conditions, which obviously have tightened. That's really driven this model down into negative. And again, there's some indicators on the industrial production side, and we've had a weak production side of the economy. So that's all sort of contributing to this. Another indicator sort of in that same vein, and we may have an indicator in that model, but people are all familiar with the yield curves, and everybody seems to have their favorite measure of the yield curve. Bond traders tend to look at 2s, 10s, and some people look at 3 months, a 10-year. Other people look on the short end of the yield curve and compare like 3 months to 18 months, and there's just all these combinations. And frankly, it's like, okay, well, if you follow that one, that's going to be the one that's not going to work next time. So what we do, this is pretty for those of you who are familiar with NDR, I mean, we do a lot of breadth work. And so we just take about 50 different indicators of the yield curve, different combinations from 3 months to 30 years. And we got as high as about 87%. We're now at 82% of those relationships are inverted. Right? So it's a pretty good signal, right? You have to go back to 2000, the last time we had a reading this high. We even went higher than where we were prior to the GFC. And in all these cases, right, the yield curve gave us a pretty good time for recession. So, that's why people pay attention to it. I would remind everybody, however, that what is the yield curve actually telling you? It's not, we've kind of assumed that it predicts recession, but what the yield curve actually is telling us is that market participants expect the Fed to stop hiking rates and eventually cut. And that's where we end up. That's why the long yields on the long end are lower than yields on the short end. And it has been traditionally because the economy is going to get soft and the Fed will have to reverse course and cut rates. And that's certainly a valid interpretation. But there is a case here that says, look, inflation's going to come down. The Fed's going to have no need to keep rates at whatever, however high they're going to get to. We'll talk about that in a few minutes and see where everybody's at. And eventually, they'll have to cut rates with it. It may not have anything to do with the economy. But traditionally, that's been the interpretation. But again, we're not too used to seeing a lot of cases where you have high inflation and it kind of just comes back down immediately. And they kind of disrupt that sort of traditional interpretation. There are a couple of other indicators that are certainly worth paying attention to. This is the ISM index for manufacturing. Now you hear people say, "Oh, it's below 50, or it's in contraction." That doesn't necessarily translate into the overall economy. In fact, we're kind of right on the cusp here of moving from sort of above trend growth to sort of more trend-like growth. And we're still far above this level that we have here that suggests we're actually in recession, which is where we get to during recessions. We get, sub 43, and we're at 48 and change. And so we're not in recession. Yeah, we're seeing weakness, but this is not the recession level that we're used to seeing from ISM manufacturing. ISM services has kind of gotten there, right? So we get to like the sub 50 reading here, 50.2 is up to the level, but basically we're sub 50 right now. And it doesn't have as long a history, so we don't have as many cases. But when we've gotten essentially sub 50, we've been in recession. And so we're getting, a reading here, and we don't want it to be a 1 month wonder. So we'd like to see, a few months here. I mean, that's what happens. The pandemic is a little weird, but normally this should hang around. So that is also adding to some concern, right, about the economy. So we talked about our indicators. We talked about the yield curve. We talked about ISM manufacturing, ISM services, and then you get into this other model that we have, which is called the U.S. recession probability model based on state conditions, and it says there's about a 10 to 11% chance that we're in recession. So this is a confirmatory model. Unlike the other model that I showed you, which was leading to coincident, this one is coincident to lag. So what's in this? Why is this so low? We just went through a mountain of evidence here that there were a lot of reasons for concern about the economy. Maybe we haven't quite gotten to recessionary levels on all of them yet, but there's a lot of reasons for concern. Well, this indicator measures employment, unemployment rate, is at a new cycle low, and income, as we've mentioned, even if it's starting to slow, is around 5-6%, depending on. So we're not in recession, and we need this to generate that recession. And so you can see once this starts to shoot up, we're in recession. Right? And so I don't have evidence of that yet. Again, this can happen. Maybe it happens in 3 or 4 months. I don't know, but I would say that we are currently not in recession based on this indicator. So as we turn over to the outlook for the Fed, monetary policy, and do another polling question. Question is, what will the terminal Fed funds rate range be? About 5.5%, 5.25%, 5.5%. Fed's area based on the latest dot plot in December, 5 to 5.25%. Or the market's sort of preferred case of under 5%. So let's give you a think about that. Most people are believing the Fed. We're going to get to 5 to 5.25%. We're going to get a little bit beyond that, about a quarter. So a quarter saying that we're going to be 5.25%, 5.5%. Only a couple of people up to 5.5%. Very few people actually are believing the market, which is kind of unusual here. I thought there'd be a heavier weight to the under 5%, what the market is actually pricing right now. So let's take a look at some perspectives in monetary policy. So one reason you could argue that the Fed has to keep at it is loan demand still is pretty strong. I mean, we're having double-digit rates of growth of business loan demand. C9 loans are up 12.5% on a 13-week annualized basis to the end of last year. Real estate loans, I thought real estate was down in the doldrums, right? 14% annualized rate of change. Now, consumer loans, right? So these are credit cards and vehicle loans, things like that. I mean, they have slowed. They got almost to 20%, and they're now down. We've seen some slowing there. Now, this loan demand is helping to sustain the economy and keep inflationary pressures sort of intact, right? If you're looking at it from the Fed's perspective, they would probably want to keep raising rates here in order to cool this demand. So this is you raise the price of money, and you'll get loan demand hopefully to slow. So this is arguing that they could keep going, and this is something under their control. The more they're going to raise the price of borrowing, then most likely that is going to reduce the amount of borrowing. The other thing they really want to pay attention to is keeping those inflation expectations well. And if you would ask me a year ago and said, we're going to have 8 or 9% inflation in 2022, what are inflation expectations going to be? I wouldn't have said well contained. I would have said, we're probably going to go up to 3 or 3.5%. And this is really surprising. So this is a Fed's measure called common inflation expectations. It comes out quarterly. We're going to get an update pretty soon for Q4. But we've gone from like just under 2 to just above it. This is not really like running away. So the Fed's got to feel pretty good about that. So this has got both market-based measures and survey-based measures, both with professional economists and the public. It's all kind of pulled together into one number, but pretty encouraging. If I'm the Fed, it's like I've described it as a piggy bank. Right? So the Fed has this big piggy bank, and they made a lot of deposits over the last 40 years. convince people that they're serious about keeping inflation down. And so when they went on this attack last year of raising rates aggressively, people say, yeah, you see the Fed going to keep inflation from getting out of hand. So the people have a lot of confidence, at least initially, about the Fed. Now, how far has the Fed gone? You'll hear people like, oh, this is the most aggressive tightening cycle in years. You look at it, the speed and the magnitude is probably the fastest that we've ever seen. But look where we came from. This is when the Fed started raising rates last March. We were minus 5% on the real Fed funds rate. And so, yeah, we've had to do all this hiking because inflation in and of itself was high. So, for all the rate hikes, we still haven't gotten into positive territory. And we've always gotten into positive territory by the time the Fed has called it quits. And the last cycle was this last one. But if you think that we might get to 2%, that short-term case that I made at the beginning, and you have 5% funds rate, let's just call that for round numbers, that's a 3% real yield. That's taken us up in here in pretty short order. And that point will be pretty aggressive, right? That will be a pretty restrictive policy. So people talk about what's sufficiently restrictive. The Fed is penciled in like 1.6% on the real Fed funds rate on its summary of economic projections. So we could actually see it almost double. What we do find historically is that the Fed tends to stop hiking rates before the recession actually hits. So there's a lot going on in this chart, but take a look at these parallel lines here. These parallel lines indicate recessions. The shaded areas indicate tightening cycles. And in every case, going back into the early 1950s here, the Fed has stopped hiking before the recession started. The only exception was 1973-74. The recession started in November 73, and the Fed kept hiking until April 74. So there is precedent for them to keep hiking into recession, but it's not the normal case. Normally, they have a pretty good idea about where the economy is and not to do it. So, and this would argue if people are right about sometime this year, then yeah, we should see the Fed stuff before we get there. Now, here's market pricing. Market says Fed funds is going to be about 4% a year out, 3% 2 years out, and sort of stable. The Fed is at 5%, 4%, 3%. This is a pretty big gap. Somebody's going to be wrong. It's not, the market isn't always right, but it's probably right more often than the Fed's. The market's saying, we're not going to be at 5% at the end of the year, and we're not going to be at 4% at the end of next year. And you're going to have to cut. And anyhow, you see very few people in this who participate in this poll believe the market. But it's been pretty consistent. If you look at where these have been going, this has been going on for several weeks now. I also want to give you some perspective, right? This is supposed to be somewhat educational as well, and we want to. This is something, an issue I have essentially with Powell. Kalish says, we own inflation. Inflation is our responsibility. We invent responsibility. We're responsible for price control. The thing is, even in Volcker's time, he had a lot of help. And if you listen to like Lagarde saying, we're going to do our job, everybody else needs to do their job. Powell hasn't reached out for any help. He said it's all on us. I think that's a mistake. You really should say, look, inflation is everyone's problem. We're going to do our part. Yes, we're a prime leader in the fight in inflation, but we need other things to happen. And think about all these other things that happened when Volcker was in charge. We had massive investment, particularly when we came out of the double-dip recession because of Reaganomics and all these tax cuts. And we had horrendous productivity that magically appeared overnight. Again, in part due to supply-side economics. Right? Then we had something that was peaking out when Volcker took over as chairman of the Fed in August 1979. We were already peaking out on reduced energy intensity. Energy intensity was starting to peak out because how long had we been living with high energy prices? About 6 years. What did that do? The pricing mechanism of the market signaled a behavior change on the part of both people demanding energy. They figured out ways to reduce their demand. Some of you may remember back in those days, we drove more fuel-efficient cars. That was when we first started doing that, rather than big gas guzzlers. We started insulating our homes better, with better insulation in the attic and around doors and window frames. And all of a sudden, like, demand for energy started rolling over. What did Volcker have to do with that? Absolutely nothing. And we started seeing energy prices come down. At the same time, that high price for energy stimulated the supply. We started seeing it increase in domestic production and domestic supply. And then, of course, OPEC became, very full of themselves and, ended up in disarray. And finally, the Saudis actually ended up, basically killing OPEC to get everybody in line, and oil prices crashed in 1986. And by the time we closed out in December of 1986, inflation had fallen to 1.1%. Anybody remember what happened in August 1981? President Reagan fired all the air traffic controllers. And Volcker has said in subsequent interviews that this was a huge help in getting inflation down. And so the degree of unionization back in 1980 was about 20%. It's about half of that today. And the president has said he wants to be the most pro-union president in history. Okay, so there are some differences here and some similarities, but immigration has been a problem for years. Going back into, Reagan's time and Carter's time, and we had problems with immigration, but we still let it happen. We're severely constraining immigration. Reduced regulation, of course, was a feature of Reaganomics and Reagan and Thatcher both. To do that, we don't have reduced regulation today. If anything, we're increasing regulation. And then number 8, which I've added in here, we changed the methodology of how we account for shelter. And we didn't like how, well, we made all these quote excuses, right, about, well, it's not really, it should be the use of shelter. That's what we should be capturing, the utility value of it, and not the investment implications. So we got mortgage rates out of it because high mortgage rates are actually increasing inflation. And so we went to this calculation of rents, equivalent rents. And the upshot was is we ended up seeing lower rates of inflation. So we changed the methodology to bring inflation down. So we have all these factors that help bring inflation down during Volcker's time that either aren't present or are only present in limited scope and quantity here today. So I just think sometimes it's helpful because you hear all this talk about, this idolizing of Volcker, and believe me, he did a lot. But it took some time too. Volcker made a lot of mistakes in 1980. In fact, when Reagan took over as president in January 81, the inflation rate was the same level as when Volcker took over at the Fed in August of 79. And essentially had been no progress in a year and a half. So it wasn't like Volcker came in and waved his wand and we all, inflation magically fell apart and, overnight. It didn't work. All right. Let's talk about the bond outlook and get into the markets here. So take a look at the tightening cycles here. Tightening cycles and yields, you'll see, again, shaded areas, tightening cycles, yields tend to be right around the end of the tightening cycle, maybe a little bit before. So, where we were not too long ago, about 430 on the 10-year. I think that's the picture of the cycle. I think we're sort of in this window now, we're getting close to the end of the tightening cycle. You look over here on the yield curve, I got 3s, 10s here, rather than 2s, 10s, slightly different. I do it for historical reasons. But again, that curve tends to bottom out, right? For the most inversion we have is around the end of the tightening cycle. It doesn't mean you immediately go into the steep here all the time, but sometimes you just go sideways. But again, you get to the end of the tightening cycle, that's about it. Spreads actually don't widen much during the tightening cycle. They actually widen during the recession. So that's here on the spread side. Now, what has me a little curious here is, quite a few people are bullish on bonds, and where is that buying coming from? It's not coming from the Fed anymore, right? They're on the other side of this. You're buying from the rest of the world. We actually still pretty decent last year, but again, keep in mind that was against the backdrop of a stronger dollar. So we've seen this come off a little bit, and probably going to come off even more. The banks have been big buyers of bonds, particularly in the pandemic period. They cut their bond purchases, so they're slowing their rates. Insurance companies, pension funds, really not big enough to talk about. Households still are actually doing quite a bit of buying. So, where is this buying going to come from? Some can come from households, but basically, I think it's got to come from people in the equity market selling down in order to have these flows go. You can mark asset prices without flows. And so inflation coming down is going to be a bigger driver. But there aren't lots of reasons for like the US market to go one way. And that's my point of the next slide here, is developed bond markets are pretty highly correlated. I've got the US as in blue, you got the gilt market here in orange, you got the twins here representing Europe, and they all kind of move together. And then you got Japan, which is kind of and so it's going to be really hard for like the U.S. yields to break down without breakdowns in European Union. And so when you think about that, and you look at the weakness that we're currently having in the dollar, and you think about, okay, if I'm a European investor, if I'm a Japanese investor, do I want to be in the U.S. market? Now, again, there was a really good reason last year because the dollar was so strong. But what happens if the dollar is no longer strong? Are you incentivized to put that money back in the U.S.? And in fact, when you look at and consider the cost of hedging, and you hedge out your currency risk, if I'm in Europe, it makes sense to stay in Europe. If I'm in Japan, it makes sense to just stay in Japan. So I don't have these flows coming in to the market this year like I've had in previous years. Volatility was really elevated toward the end of last year. And you can see this actual or realized vol in the blue, blue line here. And that's some of the highest readings. The applied vol, and there's different measures, but this is an options applied vol. And we got to, almost 20%. Look at, well, we saw that during the global financial crisis, but it's pretty rare. So we have really high levels of volatility. Are we going to, keep on to that level of volatility? I kind of I think we've done a lot on the way up, and some volatility will subside, and so that should inform us something about where we should. One of those areas, one area that does really well as volatility subsides, are mortgage-backed securities. That was also interesting, mortgage spreads rose up here during the third and fourth quarter, September, October period here, because yields were going up. And most of you probably know or remember or studied that, what makes mortgages different is they have negative convexity, right? So the curve is out. And so when yields go up, they do this. And so people don't like to have mortgages when yields are going up. And so they demand a really high yield or high spread to encourage that investment. But what about the other side? What happens if yields go down? Do we face the same negative convexity? Well, if you look at textbooks, they'll say yes. But the reality is, most everybody who owns a home has a pretty low mortgage. Most people I know are somewhere around 3% plus or minus 50 basis points. Like, you are not incentivized to refinance your mortgage. And so mortgage-backed securities are selling at discounts. And there's absolutely very low repayment risk. And default risk is zero, right? If I default and I'm buying a bond at 80 cents on the dollar, I'm getting restored to whole at 100. So mortgages are a pretty decent carry trade right now. Yeah, it's a very strange thing when you compare mortgage spreads to the ag spreads, and you see that we actually gained for the end of last year. And that was about the end of the year. The other area that looks really attractive are tips. If you buy what I'm saying about tips of the intermediate term, then you say, okay, look, inflation over the intermediate term, the tips actually are pretty decent investment. So this is something I would buy and hold. This is not a trading vehicle on this call, but a high real yield gives me, a real return with guaranteed inflation protection. Some of you are probably involved with wealth management firms. If you have risk-averse clients or people who are aiming, I just want to protect my purchasing power, I'm not looking to make a ton of money. What's wrong with tips? This is a pretty good area. And then talk a little bit about credit here. And so this is starting to be interesting. Normally, when you get into economic weakness, you'll see triple C's underperform, BA here, or double B's. Right? And normally these trends last for months, if not years. Right? You can see that is going on even before the pandemic hit. We had the 2015, 2016 energy crisis, of course, 2008 global financial crisis, the tech bubble bursting, and you had a long period here of triple C underperformance. And so, this still looks fairly early on. Well, we have a couple of key levels here, where we were at these last two lows, and you take it back to the 02 and 09 lows, you get even lower. But this still looks like it has some ways to go. So we're up in quality, but this has definitely been somewhat resilient on credit. And let's take a look at one of the reasons why is that the quality of things like the high yield index has just gone up tremendously since the pandemic. Right? So over 50% of the high yield index is rated double B, which we have never seen before. And then you look at single Bs, they're increasing, and triple Cs have basically been going down and going down, down, down. So it's not quite the same index that it was. So you can't just look at the spread of the quote high yield index and compare it to prior periods, because that quality composition is not constant. So that's something to keep in mind, and why we have spreads maybe performing and maybe a little bit better than we would have to start. Let's talk a little bit about equities. So this is something I had done last year, middle of last year, and it's one that really confounds me in terms of the stock market call versus the economy. We've never had a bear market end before the recession started. Never. And so, if we bottomed at 35, 3,600 last year, then and we weren't in recession, then maybe we're having a soft landing. We will never come in recession. If not, the alternative case is that the recession is still out there, and so on lower prices, right? Or else we just this is something we've never seen before. But this is gives me a little bit of pause, and then when I compare this is the compare I like to look at mostly for stock market valuation. It's a forward-looking equity risk premium. I use BAAs instead of treasuries and compare that to S&P. Now, why do I use BAAs? Because it's not treasuries. Because equity risk should embody credit risk. Now, I want to know how much I'm getting paid for taking on the equity portion beyond the credit portion. So I compare equities to BAA corporates. BAA relative to treasury, that's a separate decision. And what it's telling me is on good values compared to equity. And so again, I'm struggling with the equity outlook. Maybe if we don't go in recession, growth accelerates, we'll have earnings go back up. But there are quite a few headwinds here. So bonds could be a little bit better values. And then I look at profit margins, and I've got profit margins at or near all-time highs. This goes back to the 1940s, and we got the best profit margins ever. And maybe got problem of increasing unit labor costs. I know I've got interest expense that's going to go up. Depreciation is probably going to go up if we spend more on capex. If we try to find more workers, you can't. Taxes, direct and indirect taxes. I mean, all these look to me like they're at risk for going higher and for margins to come down. Not collapse, but really. Then you look at globally a little bit better. So the U.S. has been outperforming basically since the GFC, since March of 2009. And we're seeing a little bit of weakness. We're looking at the UK market a little bit better, Japan looking a little bit better, Canada being sort of the mile up trend, you go to the next page, and you really see some breakout here in Europe. This is, people were talking about Europe for years, and it's like, well, show me evidence that things are changing. I mean, we're starting to see evidence. Don't quite have it here. Pacific Japan, emerging markets, a lot of people talking about that. Not quite there yet, but I mean, things are definitely improving. Definitely, weak dollar beneficiaries, right, are seem to be doing better. Well, let's talk about the dollar and talk about this last couple of slides here. So dollar was as much as 18% overvalued. It's now about 14% overvalued in November, probably coming down somewhat in December. But this still looks extreme, right? And so the market is the dollar is susceptible for weakness. Now with the dollar weakness, you tend to get gold strength, but gold also tends to work off of real rates and these fixed yields. And it's not as tight as it has been, but it still seems to be working like lower real yields, which is a rising blue line, which is plotted upside down. So gold looks to me a little bit more attractive if the Fed's going to have to stop raising rates. Commodities, they certainly have come off their highs. We talked about this, but they really haven't broken down. This is an area that I'm watching, but commodities are also quite interesting because you have to put up T-bills for commodities, for margin, for futures and things like that. We used to not earn anything. We're now earning 4.5%, 5% on T-bills. So total returns in commodities are already going to be one leg up. And then if we get into a backwardation situation, you get some roll yield on that. If China comes back and Europe comes back and the U.S. avoids recession, you can see how commodity prices can actually see capital appreciation. So we have three drivers: commodity prices, maybe all coming in. On the housing market, I told you I would get to this. This is my estimated supply-demand balance for housing at the end of last year. We were short, basically about 2.4 million housing units. And so some of those this will probably come down a little bit in the first part of this year as we finish up a lot of construction that was started in 2020, 2021, 2022. But we're after that, it kind of dries up, and that demand will still be there. Household formation and millennials will still be drivers. So not looking for 20% price appreciation again. But can we get into the mid to upper single digits, then 10% or so? I think that's entirely. And then the last slide here on commercial real estate. The key takeaway is commercial real estate tends to underperform during recessionary periods. And you can see it during the pandemic. You saw it during the GFC. We didn't do all that much in the early 2000s, 2001 here. 1990 was a soft period, going back in here into the 1980s, kind of struggles. So commercial real estate is not the best investment during recession. It's coming out of that recession to restore the pricing. So let me sum it up here. I think inflation has peaked. Certainly looks more optimistic on the short term. Supply side challenges, however, remain agent scarcity. Long term, inflation still looks to be contained, but there's a risk, right, that inflation expectations become uncontrollable. So the economic timing model, I said, showed recession, but it's been unconfirmed. Other measures that we talked about, including the recession probability model. The Fed is seen to determine price stability. The market does not believe them. Bonds are more competitive, not only on an absolute basis, but relative to equities. Looks like a more choppy environment for equities, given the valuations. And then, alternatives certainly seem worth considering, residential investments and commodities and gold, investments outside the U.S. So I went a little over there. Then let me stop there and turn it over to you and see if you've got questions or comments.
Joe, thank you for a grand tour around the macro equity, fixed income, and dollar landscape. I will buy a couple of seconds time for you to take a breath since you've been going strong. I encourage those of you who are here with us today to ask questions in the chat. What I'd like to do is I'd like to start with hopefully a very logical question, which is, given a path to a 2% PCE, but questions about whether we'll be able to stay at 2%. We're certainly not looking at a 1970s, early 80s kind of scenario, but in a world in which there are supply side challenges, as you've talked about it, I think in a compelling way. What does the new normal look like as we think about, as we get to the other side of this and we get to more of a steady state? What's the new normal for inflation, the Fed funds rate, and for the curve? We've had really compressed term premiums, and now a negative term premium. But if we look a couple of years out, what does the world look like in those terms?
Yeah, so there's some good observations, Dan. So yeah, I think we end up in a modest inflationary environment, over that intermediate term. So again, I don't think we stay down at that 2 to 3, that 2% area for very long. Again, I made a case that we can get there, so we can get the Fed to stop hiking rates and the markets to get all giddy and all that. But the inflation probably picks back up, as some of these price pressures return on stronger demand, and that's where I think we'll end up in 3 to 4% on CPI. Sort of use that. So it's not the end of the world, but you bring it's something we can deal with. But I think you identified something that really bothers me, is that, okay, so if the only way we can get inflation to stay at 2% is to have the Fed continuing to pound the hammer with tight monetary policy, that's the only way we're going to keep inflation down at 2%, then that is a more difficult task. That's a more difficult environment. And I don't think the Fed will, be able to stay there for a long period of time. So what I worry about is that, okay, if unemployment starts to pick up, inflation is come down, then unemployment will be the bigger miss on the main thing. And they'll pivot to say, oh, now we got to fight, unemployment, and we need to get back to our maximum employment side, and then we'll see the inflationary pressures pick up, and that's when people could lose confidence in the Fed and start to see inflation expectations pick up. If inflation expectations start to pick up, the term payment starts to move back toward a positive goal. And again, people may not recall this, but if you go back, look at the term premium, it averaged like 1.75%, and we're like minus 50.
Yeah.
If we go back to, a normal term premium, we're talking 6% 10-year yields.
Yes.
Now, most people are probably haven't seen that or don't remember that. But 6% was, not that unusual. So I think that's a world we could end up with. I don't know if we'll get all the way there, because there are some reasons why the term premium is negative around demographics and income needs and things like that. So maybe we'll never get back to the mean, but we can certainly creep up into a higher level. And then, I think if we end up, and we're not going back to zero interest rates, then we'll end up with 2.5%, 3% Fed funds, and then a positive slope yield curve, and put some pressure on. So I think that's sort of where we end up.
That's helpful, and I think that's great context. I think we are two of the audience members who who remember what it was like to have a 6% 10-year and don't think of that as being particularly unusual. A follow-on question from the audience is, with the structural change in labor markets, will the Fed eventually modify its inflation targets? And I've heard this characterized as, will 3 be the new 2 as we get to the other side?
Yeah, I know that people have talked about this. So, you know, if you're the Fed, I mean, think about this. Like, when can you do that? We said 2% is our inflation target. I mean, if we do it here, I mean, the market goes like, everybody's giving up, right? They have no intention of getting to 2%. So, you know, yields are going to jump and you know, talk about the term premium pivoting. That would be a massive pivot in term premium.
Yeah.
And so, you know, the Fed is going to find it extremely difficult to move off of that. Now, if there were to be things to be made, is if we got back to 2% and held it there, and then people say, well, you know, we're at 2%, and you know, 3% may be a better target for us. But it's not because we failed. You see, we were successful. How long do you have to be successful before you can pull that off and not have the market participant, you know, fall? You know, it sounds great from an academic standpoint. You know, probably never.
Yeah, that makes sense. Turning to money supply, and I would amend this question from the audience. How do you consider money supply when looking at inflation? In tying back to the slide that you showed about loan demand or the trends in the lending markets, I would add on to this. How do you consider money supply and think about velocity of money when you look at inflation?
So I really take a broader view. I don't like the sort of traditional money supply method. If you go back, and the reason why the Fed kind of phased out, you know, focusing on monetary items is just that, frankly, this didn't work. There were just times where they just were either uncorrelated or negatively correlated to nominal GDP. It just like became real problematic. So to me, the indication about money supply growth is an indication of liquidity. It's how accommodated is the Fed, right? It's an indication of restrictiveness or ease on the part of monetary policy. So money supply is growing rapidly. It was basically an indication of easy liquidity conditions, which is generally favorable for markets, and tight monetary policy, you know, should result in negative or slowing money supply growth. My problem with money supply growth is that money supply is what's in the banking system. There's so much money created outside the banking system, non-bank lenders. It's like, why do I want to limit myself to what's going on in the money supply? So this is the problem I have with money supply as an indicator. It's like I would need a money supply indicator for non-bank. Right? That one doesn't exist as far as I know. That's my problem with money supply. So I think about it more as broadly as liquidity, and you know, I don't need to look at money supply growth to do that. I can just hear that rhetoric and you know, the level of restrictiveness by looking at real Fed funds rates, and that's going to give me a better indication of.
Okay, that's great. What are your expectations for U.S. corporate earnings this year and next? And this is certainly a hot topic, you know, really leading to the whole question of how much of a profit slowdown is truly embedded in market expectations, and you know, how are you framing that?
Yeah, you know, when I look at some of these expectations, I don't really see kind of the double-digit rates of decline that you typically see during recession. Almost every recession, you end up with a double-digit rate of decline. And so I think we priced slowdown, and I don't think we've really priced in the recession. And so look, maybe we'll get some new guidance in the fourth quarter. Season kind of kicks off tomorrow, and I'm sure that guidance will be improved. But maybe if what they're telling us is that if we don't get the recession, if we're able to have a softer landing because of the improvement in China and in Europe, then we'll see some of these numbers will be taken up later in the year. And maybe that's what the market's really thinking. But I don't think we've really priced in the recession. I think we've priced in a good slowdown, but not a real bona fide recession based on
Okay. The next question from the audience, and this is a fun one. Any concern that none of the factors helping Volcker in the early 80s appear to be present today?
I think we're seeing some of it maybe on the energy transition. We're going to move away from some of those high price fuels. But yeah, I mean, there is concern. I mean, that's why I listed them there. But I do think we'll see productivity pick up. We're going to see some improvement in terms of investment from some of these bills that were passed last year. Build Back Better, the CHIPS Act, Inflation Reduction Act, and some of that's going to start to unleash things. And you'll just get a normal pick up in activity. We have some really strange things going on in the labor markets. Having a lot of people who can't, and so you have to kind of understand why did productivity go down. And a lot of it has to do with we had older workers exiting the labor force sooner than was expected, and they were replaced by newer workers who are experienced. We had hot labor markets, and we had a lot of job shifts, and a lot of this just kind of weighs on productivity. But eventually, I think productivity will come out, and so we'll see some pickup in investment, some pickup in productivity, maybe some pickup, in terms of reducing energy intensity. Again, you think about what's going on in Europe. I mean, it's all about reducing energy intensity. So that takes time. But yeah, there are clearly other factors here that are not cooperating. And that's why, I'm saying we should see some moderate inflation over that sort of 1 to 5 year time horizon. There should be this 3 to 4% inflation. There's going to be some factors that are just not going to be real helpful to get inflation down in people.
Have you, and think about labor participation, a big part of the jobs gap, in addition to the fact that the immigration gates have largely been closed, but the over 55 segment of the labor pool, and really in particular the over 60s, there's a big gap between participation in that segment today than there was pre-pandemic, and that gap hasn't really closed materially. Have you seen insightful research into? I think we have a high-level view of what the causes might be, but have you seen any real insightful research explaining that continued tendency and hypothesizing what that could look like over the next couple of years? Is there any research you've done or you've seen from the regional feds or other researchers that helps provide insight into that subject?
I think there were some reasons for it. COVID had a lot to do with it, but people also had a big financial cushion. Retired, right? The markets are doing well, their houses are doing well, and I would have expected a few more people to have come in. Because it got a little tougher to make ends meet. So we're probably not going to see that rate of retirements carry through, over the next couple of years, particularly this time when people know about potential recession. So we're probably not going to see that rate of retirement and early retirements going through. So we'll probably see that participation rate at least stabilize, right? It shouldn't get worse. It may pick up a little bit. But as the degree of COVID come off, number of people don't retire at the same rates. So those are a couple of factors. But yeah, I think what's more troubling to me is why the climate, particularly for men, we're about 1%, maybe a little less than 1% point away from the pre-pandemic levels. I mean, I get, older people are close to retirement, okay, so they just call it quits earlier, but why are people under the age of 55 not fully participating? And that's a little bit, I used to think, well, maybe they're 14 Bitcoin and that kind of went away last year. So why do people not coming back? And I think it's COVID. I think it's opioids, things like that. That are just there really aren't a lot of good reasons. Those are some of the reasons that we talked about, and some others as well. But nobody really
Okay. A last question in light of the time from the audience. Do you subscribe to the theory that higher interest rates can actually sustain inflationary pressures as bank lending becomes more profitable?
I really don't. Essentially, somebody has to pay the cost, right, on borrowing. So higher interest rates means that whoever is borrowing money is going to be paying more for it. And if it's first a few cents on the dollar, maybe it's not a big deal. But as it gets to be 10, 20, 30%, the higher it goes, the more impact it's going to have. Now, people may laugh at that. I mean, but take a look at what credit cards are. I mean, if you've got credit card debt, I mean, 15, 20%, 25% is not unusual.
Yeah.
How long can you sustain that? So maybe if you're a low credit risk, it's not a big deal. But the more you hike, the more more disincentivized you are, if you will, to without borrowing, the less incentive you have to take on more of that debt. So I do think at some point it just kind of becomes exponential. Interest expense just kind of feeds on itself, and you end up blowing yourself up. So yeah, I think that absolutely will work.
Great. Any closing words of wisdom before we wish everyone well today?
No, I really appreciate everybody joining and participating in the polls. Really interesting to see how the people on this call differed a lot with what the markets are saying. That should always give us pause. The markets are a collective wisdom of everybody. And so when the markets are different from your view, you at least question your thesis. So, what am I missing? What am I not seeing? It's when those points in the market that get overboard that actually can give you opportunities. But you should always check your thinking against the markets.
Great. Well, thank you so much. This has been great. I was taking copious notes in part so that I could try and help move the question and answer period along. But also because I got a lot out of this. This will help me in what I do with TFC's clients. So I appreciate the time, and it was a real treat to be part of this. So thank you. And thanks to everybody who joined us today.